Well, Asian markets, they are trending higher after an overnight bounce on Wall Street. All eyes now are on the G20 summit. That's set to take place in Argentina later this week, where President Donald Trump and President Xi Jinping, they are due to meet. So all eyes out there. Can they call for a trade truce? That's something that everyone's looking forward to. But for the time being, most of those markets are trading with some green. The Nikkei, that's sitting with a gain of around 0.2%. Remember, besides the positive global setup, you also have the yen. That's a bit of a tailwind out there. That's moved to around 113.5 odd. Remember, just a few trading sessions ago, it was at around the 112.5 odd mark. The Kospi, though, that's come off the high point of the day. We're sitting with a gain of around 0.2%. So keep an eye out on that one. I think the other couple of markets as well have flattened out, and both of them are sitting with some cuts now. So Asian markets off the high point of the day. And for starters, the SGX Nifty is indicating maybe, in fact, we'll give back close to around half of what we put on yesterday. Interesting to see whether or not that happens. But for the time being, the SGX Nifty is indicating a 50-point downtick.
Well, yes, naturally mentioned all eyes are on G20 summit. An important commentary coming ahead of that, wherein Donald Trump said in an interview that it is highly unlikely that he would not go ahead with putting tariffs on January 1. And this comes ahead of the G20 meeting, which is lined up for this week. And there were also comments regarding a 10% tariffs on Apple products from China. So that is perhaps kind of a niggling worry, and that's the reason perhaps Asia is off highs. But otherwise, in the US markets, the stocks closed higher as beaten down tech stocks rebounded from steep losses. Now, last week, the Dow Jones rose, yesterday actually, Dow rose over 350 points, posting its biggest gain since November 7th, while the S&P 500 gained around 1.5%. The Nasdaq Composite outperformed, and that index rose by over 2%. Stable oil prices also aided sentiment. CNBC's Eric Shemi gets us a wrap of all the action on Wall Street.
U.S. stocks starting the week with a bang. The Dow adding 354 points, the S&P up 40, and the Nasdaq up by 142. General Motors saying it will lay off more than 14,000 employees and halt production at several North American plants next year. Those plants are in Ohio, Michigan, Maryland, and Ontario. GM says the move will save roughly $6 billion by 2020. President Trump telling reporters he was not happy with the news. Shares of GM, though, up nearly 5% today. Online shoppers doing some serious buying this Cyber Monday. Sales expected to top $7.8 billion today, according to Adobe Insights. That makes it the largest online shopping day in U.S. history. It comes off a strong showing on Thanksgiving and Black Friday, when Adobe says online shoppers bought nearly $10 billion worth of goods. And IBM CEO Ginni Rometty calling for regulation of consumer-facing tech companies like Facebook, Google, and Amazon. Though she did not directly name the companies, in a speech to EU commissioners, Rometty said that irresponsible handling of personal data by those companies should, quote, not define the digital economy. That's the action from the U.S. market. Back to you in Mumbai.
Okay, on that note, here is some opinion from Morgan Stanley and Citi on the road ahead for the U.S. market and how factors like lower crude prices and Fed's rate trajectory will impact the emerging market action, including India.
We have a below consensus growth forecast for the U.S. economy next year. We have U.S. growth slowing all the way down to a 1% annualized growth rate in the third quarter. And so we think that that, one, will reduce overall optimism towards U.S. assets, but specifically result in a pretty large deceleration in earnings growth for the S&P 500 from the current level of a 20-something% year over year for S&P earnings to just maybe 4% year over year next year. So a slower economic backdrop, weaker earnings growth, you couple that with continued tightening in the first half of next year from the Fed, and I think it's all a cocktail for a much more difficult outlook for U.S. equities relative to the rest of the world. We think the outlook in India is relatively attractive, given what's been happening with oil prices recently. We actually think the outlook in China next year could be somewhat better than low expectations currently say. We see odds that we'll see further fiscal stimulus there that will help stabilize the economy and stabilize growth. You have had an enormous repricing of EM assets, and again, the price matters. You've had a very significant derating of EM equities. You've had a very significant, even on the fixed income side, widening of credit spreads. So, look, EM still has challenges. It's still going to have fundamental challenges next year, but the price is a lot better.
Price of oil will determine what's going to happen in terms of E&P activity. Number two, is the idea of the Iran deal and the exemptions, 800,000 barrels, was not expected by the market, so there's more supply in the market than what had been anticipated. And lastly, there has been some sluggish demand, but primarily it coming out of non-U.S. marketplaces, particularly China, where there's been some weakness, and that's been kind of the incremental driver for more demand. So energy's been under pressure from a number of different perspectives. The lower price is a clearing mechanism. Is it good for consumers? Yes. Is it bad for Texas economy? Yes. So it's kind of a little bit of a push either way. Our global view is that emerging markets have some opportunity as well. U.S. has been a bit of a safe haven market relative to the world. The economy is stronger here. We got the buyback activity here. We've got a stronger economy here. All those are very important dynamics. What I would suggest to any investor who's trying to think about global positioning is look at the dollar. If you have a very strong view on the dollar going higher, U.S. tends to outperform emerging markets, tends to outperform everywhere in the world.
Well, tech and industrials, they have been the worst hit in the recent market correction. Now, these are sectors that were responsible for market highs when Donald Trump was elected as the president. Now, as Steve Leavesman reports, that there may be a case of money exiting from both the sectors, and it may also be raising broader concerns on the administration's policies. Let's listen.
The old saying goes, the harder they come, the harder they fall. That may apply to sectors that have led the charge since the election of President Trump. They have mostly led the market lower since the top on October 3rd. So is it just a case of the market correcting itself or overbought sectors selling off, or have investors fallen out of love with the Trump trade? The top three sectors since the election gained 51%. They're now down 11%, while the bottom three sectors were up only 3.4%. They're off 2%. Looking specifically at sectors, it was IT that led the market higher, 67% from the election through the top on October 3rd. It's down 15%. The leading sector up and the leading sector down. The number two spot goes to consumer discretionary, up 47% and down 13%. The Trump administration says the benefits of tax cuts will build over time. It'll prompt companies to invest, boost productivity, and also increase worker wages. But among the sectors that would benefit most from this, industrials, they were up 33% from the election. They're now off 12%. And Morgan Stanley, broadly pessimistic about earnings next year. In a commentary, they wrote, quote, there is a greater than 50% chance we experience a modest earnings recession in 2019. This growth disappointment is likely to be offset somewhat by a Fed that pauses its rate hike campaign by June. Now, it could be that all the trade disputes are troubling the market, along with concern over the Fed and higher interest rates. But the optimistic view that the upside of tax cuts would reduce the downside from these other issues seems to be at least an open question in markets today.
Well, in European markets, they entered in positive territory. Investors out there, they digested the fresh developments surrounding the Brexit after European Union backed Prime Minister Theresa May's deal. Now, the rebound in oil prices as well, that as well helped boost sentiment. So all the three frontliners, they ended in the green. But it wasn't just the frontliners. The Italian index, that was up more than 2.5% yesterday on hopes that the government may be able to find some sort of a common ground with the European Union over its budget. So that market, in fact, was a big outperformer yesterday, up close to around 2.8%, nearly around 3% is the run we saw there.
Okay, and in the world of commodities as well, the oil prices clawed back some of the steep losses that we saw in the last 7 weeks and rose nearly 3% overnight. Now, prices fell to their lowest levels in more than a year over the weekend amid growing concerns and worries of an oversupply in the oil market. Remember, OPEC and its allies are set to meet in Vienna next month, that is on December 6th, and they are expected to announce that output will be curtailed.
And in the precious metal space, gold prices hold. They are supported by uncertainty over the pace of U.S. interest rate hikes. And also all eyes on the outcome of the G20 summit later this week, when political leaders will focus on the current global trade tensions.
Okay, it's time now for a break on the show. The first one, we'll take a short break. Come back, we'll tell you all the cues and news you need to know for trade this Tuesday morning. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC TV 18. And back home on the Lord Street, the Nifty gained close to around 1% to end the day above the 10,600 mark. The Sensex added nearly around 350 points, and the Nifty Bank, that was a big outperformer, though the mid-caps, they ended with just minor gains, relative underperformer in yesterday's trading session. For the time being, the SGX Nifty is indicating a bit of a cut. But Anisha is with us. Anisha, tell us, what are the cues you're looking at?
Oh, well, yes, Nigel, as you mentioned, yesterday all the major indices ended at the high point of the day, especially the Nifty and the Sensex and the Bank Nifty. Mid-cap index, yes, was a tad bit of underperformer, but that too recovered around 150 points from the day's low. We got buy figures from both the FIIs and DIIs as far as the cash equity markets go. So FIIs bought around 62 crores, while the DIIs, they bought around 350 crores. As far as the cues for today is concerned, if you look at the global markets, the cues are a bit mixed. Yes, the US markets ended well in the green. The Dow is up around 350 points. S&P gained 1.5%, and the FANG stocks, they all rebounded, and that's the reason Nasdaq outperformed and was up around 2%. So all these beaten down names, whether Amazon, Google, all these stocks rallied and were close to over 1%. What the street is watching out for is the speech coming in from the Fed Reserve Chair Jerome Powell later in the week. And of course, all eyes are on the G20 summit. Now, after the market closed, there are some interesting comments that came in from President Donald Trump. He said that it is highly unlikely that he will not go ahead with putting that 25% tariff on $200 billion worth of goods, which is expected to happen in coming January. He said that they might impose a 10% tariff when it comes to the Apple products being imported from China. Remember, as of now, Apple products are exempt, and that's the reason perhaps the Apple stock tumbled around 2-3% in the aftermarket trading session. So that is something perhaps which is worrying Asia as well, because if you look at the Asian screens, well, we had opened well in the green. We are still trading in the green, but if you look at Nikkei, we are trading at the low point of the day, pretty much around the flat line now, so giving up all the gains. And similar is the case with Kospi as well. We started off well in the green, but that too is trading near the day's low. In fact, it has moved into the red, down about 0.1%. Hang Seng and Shanghai, the early rates were also suggesting a bit of red cut, and as a result, SGX Nifty, that one is telling you that we might see a cut of around 60 points. As far as the other cues are concerned, crude of course has rebounded, but it continues to hover in that $60 to $61 per barrel mark range. As far as rupee is concerned, the dollar index is over the 97 level now, and that's why perhaps despite of having positive cues, the rupee weakened yesterday. It ended at the levels of around 70.9. We have a lot of important cues lined up for the week. The state of Madhya Pradesh and Mizoram go to poll tomorrow. We have FNO expiry coming up this Thursday. India Q2 GDP data and G20 summit we have been talking about. So those are the cues to watch out for the week. But Nigel, for Nifty, the important levels to watch out for on the downside is a 20-day moving average of 10,489, 50-day moving average on the upside at 10,679, and 200-day moving average at around 10,750. So we'll watch out for all these levels as well.
Absolutely, Anisha. And yesterday's trading session, we bounced off the 20 DMA. That's what gave the bulls, some heart. And ahead of FNO expiry, the bounce like that is what you see. Then, in fact, in those short positions, they'll get nervous and they may shut down as well. And that's what could give the market some legs as well. But we'll wait by for the opening today. Meanwhile, tell us what kind of, what are the stocks you're looking at for today's trading session?
Well, Nigel, Yes Bank in the last, half an hour dying minutes of trade actually rebounded, and that was because we picked up a source-based story saying that Yes Bank promoter companies have prepaid around 400 crore loans to mutual fund companies. So I'll continue watching out for that, and especially because there has been another news report that RBI is actually studying Yes Bank's exposure to NBFCs. So all these companies like Indiabulls as well as DHFL will be in focus on account of that. Sun Pharma, there is a news that the company has made an acquisition in Japan, and the acquisition price is close to $1 million US, so around 700 odd crores. And separately, they have settled some stakes in the US as well. So that is something to watch out for. Separately, on Jet Airways, we are picking up a story that the company is looking to cut workforce, and they have cut some workforce in Kochi and Hyderabad as well. So there might be some positive cues that the street can take from it, that the company is really taking effort on the ground to cut down their costs. Moving on, there is a report for Future Retail and Future Group of Companies that Mr. Biani may give buyout right to Amazon. The story has been developing for a while. Let's see if we react to this or not. Unichem, a news coming in that the Mumbai's office has received an establishment inspection report, so that's a positive. IFCI has recovered 490 crores on account of Banani Cement, so that's a positive as well. Just quickly mentioning Navbharat Ventures because they have got they've signed contracts with Tata Power, and that's at a good rate of around 5.75 per unit. So that will be in focus as well.
Okay, thanks so much, Anisha, for running us through all the market cues as well as stocks that we'll be looking out for. Let's slip into a short break on that note. But as we do that, let's hear out some opinion coming in from Vikas Khemani of Carnelian Capital Advisors on the sectors he likes as well as where he sees opportunities.
As far as the IT is concerned, we are in a reasonably good phase where we have started to see a demand pickup, volume pickup across the board, and especially for the mid-cap IT companies, smaller 500 million to $1 billion kind of size companies, and I think they have a good chance of growing. But overall, PAC is growing. If you see the kind of inquiries, order book is getting built very, very well. Structurally, India will depreciate 5 to 6%, and that helps IT company in general. So I would like to remain positive, or I remain positive on the sector, given the fact that there's a strong demand environment in the developed markets. Structurally, consumption, you can't go wrong as long as you have taken good quality companies, and of course they are expensive, but as long as the demand environment, which I think is likely to remain strong over the next 5-7 years, you would do well. In QSR space, you got to have the right business model, and I think something like Jubilant has done reasonably well in getting right scale, right business model, right growth. I think they would do well. I don't have a significant view on a lot of other players, but I think QSR in general is a very good space, and I think will do well over a long period of time. Indian markets were in a trouble situation, hence you saw significant correction, and whenever this kind of correction happen in a very high quality stock, you tend to kind of look at it as an opportunity. So I think Maruti will continue to do well, and again you can look at different players like Hero Motor, I think would do well. Ashok Leyland, I think, is very well placed, if you ask me, in my opinion. So I think automobile as in general space looks reasonably well, and most of the stocks have corrected significantly in the in the recent past, and I do believe they are a good franchisee offering good returns on capital and good growth.
See nothing wrong in the market that suggests anything adverse is happening in India. That's the word that's coming in from Arvind Panagria, former VC of Niti Aayog. Now here's a snippet of that exclusive conversation with CNBC TV 18 Shireen Ban, where he talks about the contentious issues surrounding the government and the central banks, and also the cleanup needed in certain banks.
Both sides are working in the national interest. I have no reason to believe that the RBI is not working in national interest or the government is not. So I think they're both, there may be differences in points of view which evidently exist. But nothing seems to me to be here that cannot be resolved through discussions. And I'm glad these discussions are now happening. In so far as liquidity issues are concerned, you are closer to the ground. My own sense is that the economy is doing reasonably well. So overall, I suspect that this couldn't have been happening if demand had sort of collapsed or in a major way had seen a huge decline. So unless this is reflected in some of the indicators, it is difficult to tell. I mean, I don't see any obvious kind of indicators which are suggesting that somehow the economic growth is being adversely impacted. That being said, I think, clearly on the banks, we need cleanup to happen. We need, if liquidity is short, then it needs to be infused. So let's wait and see. I mean, things are looking a lot better, at least, just reading the press, than they did when I was in India about 3 weeks ago.
Yes, that certainly is the case, sir, at this point in time, post that board meeting which lasted for about 9 hours or so. But let me again ask you, sir, what is the sense in the international community, people that you may be speaking with respect to what is happening here, especially when it comes to questions being raised about the independence and the autonomy of the Reserve Bank of India being compromised? The government says that's not the case at all. All we are saying is that concerns of the real economy need to be addressed by Mint Street as well. What is the global response and reaction to what's been happening here, if anything at all?
No, none. I mean, if there were these reactions, you will see it in the markets, right? And I see nothing in the markets to suggest that there is any adverse impact right now of what is happening currently in India. And in any case, if the markets are rational, they will see that in no way has any damage to the autonomy of the Reserve Bank in terms of handling the monetary policy or exchange rate management has happened. Now, there are issues of discussion on regulatory side, and that is something on which, even in the US, after all, the Treasury and the Fed Reserve do speak to each other. It is not as though they work in silos entirely. And we do know that, when the 2008 crisis happened, both the sides, the Treasury and the Fed Reserve, worked in very close cooperation. And in fact, the Fed Reserve did things that it would normally not do. I mean, a lot of the cleanup, the TARP and so forth was done by the Federal Reserve. So they understand that, when major issues are involved, particularly if the prices, then cooperation is natural. And on regulatory issues, in any case, the two sides, in our case, particularly in Indian case, a very large part of the banking system is owned by the sovereign. And so, therefore, it is inevitable that the two sides will have to talk with each other on regulatory issues.
All right, let's slip into a short break. Up next, the PSU banks to get fund infusion of 42,000 crore rupees in the second tranche this fiscal. More details when we return. Stay tuned.
Is gearing up for a second round of fund infusion into the public. Now, sources tell us that the government will to infuse 42,000 crore in the form of recapitalization. Now, let's go across to Sapna Das, who has been getting at. Sapna, tell us which banks are this exercise.
We have been given to understand that the 11 banks which are currently under the PCA framework, all of them will be up for regulatory capital sometime end of the calendar. That's the sense that we have got. Apart from that, the may not require growth capital. Bank of India may not require any growth capital going forward in the current financial year. Similarly, probably also for Punjab National Bank, because 2 tranches of recap have already happened. So probably PNB may not figure in that list of recapitalization, which is going to be announced towards the mid of the month, next month, or probably by the end of the calendar, definitely by the end of the calendar. So apart from those 11 banks which are under PCA framework, which will definitely require, regulatory capital, it remains to be seen whether there will be any other banks, which may be up for recapitalization. But the sense from the government clearly as of now is that it will be those 11 banks which are under the PCA framework, which primarily need the support of recapitalization. So 42,000 crores is what the government is left as of now in terms of the PSB bonds. And all of this amount we are given to understand will go through by the end of this calendar year. It could be in one go, or it could also be in 2 goes, in the sense there will be 2 separate lists that the government may be looking at. So that number crunching is on as of now, and probably in another month's time we will know who gets how much.
All right, staying with news from the financial sector then, the Reserve Bank of India has further eased norms for overseas borrowing. Now, the central bank has reduced the mandatory hedging requirement for borrowers raising overseas funds to 70% from 100% earlier. The move is in a bid to provide some relief from the liquidity crunch and will apply to all housing finance companies. But this will not be applicable to all NBFCs, and only those that deal with infra financing and asset finance companies will benefit.
Okay, now let's talk about one decision that is very close to the hearts of customers and has been getting a lot of backlash on social media. Now, the decision by low-cost airlines to levy an additional charge on seat selection by passengers who check in online is now under the government scanner. Now, in a statement, the Aviation Ministry said it has noted how some airlines are charging a fee for all seats via web check-in and announced a review to determine if this falls under the unbundling framework. However, remember, Interglobe Aviation did issue a clarification yesterday saying that the pricing is only for advanced seats, and when a customer checks in at the airport, seats would be assigned for free. Now, we spoke to a whole host of aviation experts on the matter. Let's listen into what they had to say.
If you're charging for every seat on a web check-in, then that's clearly against the existing guidelines, which allow only for preferential seating. So preferential seating would mean the exit row where you have extra legroom and so on. But if you're going to have a charge for every seat, then in effect you're increasing your ticket price without really increasing it. So it's sort of a concealed or a price creep. There will always be this issue, and airlines will look at how they can claw back revenue without really raising the ticket price.
Preferential seating is not defined in the DGCA circular. So what Indigo has done right now is to expand the ambit of preferential seating. They're saying anything that is not assigned at the airport is preferential seating, because you get to pick a seat on your own without us having being involved in that. Yeah. So this is only going to go forward.
Well, staying with the aviation space, then, saddled with debt, Jet Airways continues to cut workforce and shut down smaller operations as it attempts to turn the airline around. Now, sources tell us here at cnbc TV 18 that Jet Airways have told around 11 ground staff members in Kochi to leave, and has also stopped contract renewals for cabin crew members over the age of 40 years. The airline has also shut its Hyderabad sales office, asking 4 employees to leave, and is also looking to reduce their operations on non-profitable routes. Now, Jet Airways has responded to cnbc TV 18 in a statement that the company said, and I quote, "Jet Airways has undertaken a series of initiatives to enhance the economic performance. Capacity is being moved from uneconomical and point-to-point routes," end of quote. It went on to say, and I quote yet again, "The company is optimizing its resources in select cities, including redeployment resources where needed, for greater synergy with revised level of operations," end of quote.
Okay, moving on to another important story now, and this one is from the pharma space. Now, from the US FDA Commissioner in US, we hear from Scott Gottlieb that in a CNBC exclusive, he says that the Food and Drug Administration plans to overhaul more than 40-year-old process for approving medical devices. He also talks about drug prices and vaccines. Here's a snippet of that conversation.
The overall rate of inflation in the drug sector, the branded drug sector, has been largely flat. So drug prices overall have flattened out. Obviously, some individual companies are taking price increases on selected products, but a lot of the generic competition that's coming into the market is really depressing the overall inflation. Now, prices haven't come down. You haven't seen price cuts, but you haven't seen the kind of 5% and 6% inflation overall across the market that we were seeing year over year. Last week we announced some new rules around safety, some new efforts we're making around trying to ensure device safety, do better post-market surveillance, active surveillance of medical devices in the marketplace, and declare that FDA and the U.S. should really be the first regulatory agency in the world to be able to spot a safety signal among world regulators. Today we're making another major announcement about a really significant modernization of the device approval process. A lot of devices come to market by basically demonstrating that they're substantially equivalent to an existing device, but they use as a predicate the device that they're comparing themselves to, a device that's sometimes many decades old. What we're saying now is we're going to make it easier for device companies to establish new predicates to use as standards for approval, but we're also going to be looking to retire some of the older predicates that companies have been using as a basis for their approval.
Well, time to slip into a short break. Up next, as Rajasthan gets ready to go to polls on December 7th, CNBC TV 18 reports from the textile hub of Bhilwara, where the industry has a long wish list. Stay tuned for this special report. Well, in Rajasthan, high electricity tariffs are a major issue for industries, and Parishit Luthra visited one of India's largest textile hubs in Bhilwara, where high electricity tariffs, coupled with the recent ban on the use of pet coke, has impacted profits by 20%. Here's a ground report.
Bhilwara city, located at a distance of 260 kilometers from Jaipur, is one of India's biggest textile manufacturing hubs. In fact, 60% of the country's synthetic fiber production comes from these weaving units. Bhilwara has 500 textile manufacturing units with an annual turnover of over 21,000 crore rupees. Approximately 1 lakh people work in these industries and another 60,000 would be employed indirectly. Home to companies like Hindustan Zinc, Bhilwara is clearly an industrial powerhouse, but traders here complain that business is down by at least 20% because of high electricity prices and the recent ban on the use of pet coke.
आने वाली जो भी सरकार आवे, हम चाहेंगे कि भाई इलेक्ट्रिसिटी रेट कम से कम 2 रुपये यूनिट कम करनी चाहिए। दूसरा ये है कि पेट कोक को अलाउ करना चाहिए क्योंकि कोल इंडिया से कोयला ही नहीं मिल रहा है, इतना कोयला महंगा आ रहा है और पेट कोक से हमारी कॉस्ट भी कम पड़ती है। तो जब हमारे दूसरे पड़ोसी स्टेट्स हैं, मध्य प्रदेश, महाराष्ट्र, ये गुजरात, ये यूज कर रहे हैं, तो आज हम तो उनके सामने टिक ही नहीं सकते हैं। तो इसलिए आप देखेंगे हमारा यहाँ का प्रोडक्शन पिछले 6 महीने में 25% के आसपास कम हो चुका है।
Industrialists here say that they have to shell out 7.8 rupees for every unit of power, which is the highest tariff in the country. While there is appreciation for the state government's efforts in bringing in Rajasthan investment promotion policy and reducing GST rates, members of the Mewar Chambers of Commerce admit that many of their requests have fallen on deaf ears.
Demonetization and GST, the sales have gone down. Production has also been affected. It has gone down by almost 25% now.
जो बांग्लादेश से जो 0% ड्यूटी के ऊपर जो ये कपड़ा इंपोर्ट किया जा रहा है, जब तक इसके ऊपर बैन नहीं लगेगा, तो ये जो दुनिया की वर्ल्ड क्लास की मशीन्स के ऊपर जो लेटेस्ट प्रोडक्शन, जिसमें डेनिम पर्टिकुलर एक आइटम भीलवाड़ा ने 1.5 करोड़ मीटर पर मंथ के ऊपर हम प्रोडक्शन पे आ चुके हैं, इसकी मार्केटिंग के लिए हम लोगों को एक बहुत बेसिकली प्रॉब्लम आ गई। इस प्रॉब्लम को दूर करने के लिए हमारी तरफ से सेंट्रल गवर्नमेंट से हम ये डिमांड करते हैं कि जो जैसे कि बाकी कंट्रीज से जो भी इंपोर्ट होता है उस पर 20% इंपोर्ट ड्यूटी लगती है, तो बांग्लादेश से जो कपड़ा आ रहा है वो 0% ड्यूटी पर आ रहा है।
The Nirav Modi Mehul Choksi scam, do you think those incidents have made it more difficult for traders and businessmen to get loans?
Yes, because many of the banks, they have come under the PCA. So once they have come under the PCA, they stop lending. Unless after stopping the lending, that where the intermediary will go, even the rate of interest and the what you call the limits, that has been reduced. So when you talk about the 3 points, one is the availability of the credit, that is not, because most of the banks, they have stopped, we are not able to lend it. So unless we are able to get a finance, how the industry will prosper?
At present, Bhilwara is mainly a weaving hub with only 19 processing units. Businessmen here hope that the next government would look into their demand of increasing water supply so as to encourage more processing units.
Textile manufacturers here in Bhilwara feel they haven't received enough attention from the government, despite the fact that this is the biggest textile manufacturing hub in India. Many of the issues they are facing have to be addressed by the central government, but manufacturers here have 3 key wishes from the next government in Rajasthan. Firstly, reduce electricity prices, make sure that traders, manufacturers get better credit facilities, and number 3, urge the central government to introduce the national textile policy at the earliest. With video journalist Lakshman Singh in Bhilwara, this is Parikshit Luthra.
Okay, on that note, let's slip into a quick break. Up next, we'll get you a check on the cues to watch from the futures and options space. Stay tuned. Well, crude had fallen 30%, over 30% from its high. Yesterday, it recovered a tad bit in the session, but today as well, it's coming back off the highs, currently trading at the $60.2 per barrel mark. Let's go across to Manisha Gupta to understand the cues coming in from the commodity and currency space. Manisha, good morning. Over to you.
Thank you so much for that. Well, it continues to be volatile when it comes to the crude oil prices. A 7% move down one day and a 3% move up the other day. But then that's how the markets really are. And as we get into December, we will be getting into a more holiday kind of a period where you would see less participation, people winding up positions, not long positions being created. And it really is about the two events that the crude oil prices will watch out for. One, of course, is the G20 meeting on 30th November and 1st of December. We will be hearing a lot of statements out of that. And the next, of course, is the OPEC meeting on 6th of December in Vienna, and the output policy that the OPEC and allies would come in from that. In the meanwhile, you also are looking at the Saudi Arabia output, which is at a record highs. And even as you will see an output cut policy, it would be on these heightened levels. So that is what the markets really are bothered about, on whether or not it is going to be enough output cut to support the prices. In the meanwhile, while of course for the very near term, it is going to be choppy, perhaps for the downside as well. But as we get into 2019, more and more banks believe that for the Brent prices, it is going to be between $70 to $75 per barrel as an average price for the next year. So there is some consolidation that you can expect in 2019. But for the next 1 month, it is going to be quite a heartache when it comes to the crude oil prices in the sense of volatility that we are seeing. In the meanwhile, you also have seen some decline continue for the metal space for a third straight day. So whether it is gold or the industrial metals in Shanghai right now, most of them have started the Asian trading on a weaker note.
Okay, all right. Thanks so much for that, Manisha. Well, let's hop across to Mangalam Malu. He's standing by to tell us what's going on in the derivatives market. Hey, Mangalam, morning.
Morning, Nigel. So as expiry week began yesterday, a couple of things that really stood out from both the flows as well as the derivatives perspective. The first one, FIIs continued to buy in cash market, albeit much lower than what they did in the previous trading session, but it was a buy figure from both the FIIs as well as the DIIs nevertheless. A total inflow of close to around 410, 415 odd crores in the cash markets. The live intraday indicator that we have is the Nifty futures premium. Yesterday, we went into trade with a discount of about 2 points, and by the end of trade, the Nifty November futures premium came in at around 10 points, 3 days ahead of expiry. That's telling you that there was purchase at lower levels. But it wasn't particularly the FIIs who were buying, because if you take a look at it, the 168 crore worth sale in index futures, this despite a 100-point up move on the Nifty. That's because while a part of the FIIs added close to around 11,000 long contracts, there were 17,000 short contracts added. So let's see what happens at higher levels given the 50 as well as the 200-day moving average upwards of 10,650. The index options, though, the data was extremely positive. Roughly 15,000 long calls added 3 days ahead of expiry, and part of the exaggerated up move that came in yesterday was also on account of short call covering, because remember, the 10,600 calls saw a fair amount of short covering. The Nifty put call ratio, a number that we track very closely, moved higher from 1.5 to around 1.65, still lower than overheated zones of upwards of 1.7. In terms of active options, we had the 10,600 and the 10,700 calls shedding some shares in open interest. The bears feeling a little jittery after the up move yesterday, while at the lower levels we found support at 10,500 as well as the 10,600 puts. So any downtick that the SGX Nifty indicates may find some support is what the options data tells you.
Okay, so perhaps some support coming in at the lower levels. Thank you, Mangalam, for that. But let's now go across to Sonal, who's standing by to tell us a list of stocks that will react to some news reports perhaps today. Sonal, good morning. Over to you.
Good morning, Anisha. Well, a lot of pharma stocks will be in focus because a lot of US FDA approval is coming in for them. So starting in Granules, that has received a nod for one of the tablets which is used for treating narcolepsy. So that stock will be in focus. Cadila also will be in focus because they have received US FDA approval for one tablet that is used to treat muscle spasms. Alembic Pharma will also be in focus because they have received nod for an anti-insomnia drug, something that some of us could use. Apart from that, a lot of stocks will be in focus because of the brokerage action, where Morgan Stanley, that has turned a little cautious on the Indian metal sector. So they say that domestic steel profitability is at peak and they only prefer companies with strong balance sheet and stronger cash flows. And they also think that the demand for steel is right now at a risk. So following that, they have cut down target prices and the targets for a lot of companies. For Coal India, they've upgraded the stock to an overweight, but they have cut the target price to 296. JSPL has been downgraded to equal weight from an overweight. They've cut the target price as well. Same case with JSW Steel. They've downgraded the stock and cut the target price to around 278 rupees. For SAIL, they maintain their underweight rating, but they've cut the target price to 53. And it'll come up on your screen. They have cut target prices for a lot of the stocks under their coverage. Now, Deutsche Bank has written on Siemens. They have cut the target price to 1120 from 1130 rupees per share, and they've also cut their EPS estimates. However, they think that digital factories and building segments are too high return of capital employed segments that will lead to future growth. Back to you.
Okay, all right. Thanks so much for that, Sonam. Well, on that note, we'll wrap up on Power Breakfast. You stay tuned. Bazaar Morning Call comes up next.